report presents a preliminary financial analysis of CHAINZ bicycle company. The report is based on financial statement analysis of the year 2014 to 2017. The CHAINZ bicycles company serves the mountain bike sector with a medium price, low volume strategy. The company competes directly with Hot Wheels in this segment. The 2017 results include sales, which is $30,170,507, and its units sold 25,708 units, and it cost $4,798,222, and its profit $7,390,285, and its shareholder value is $20.01, and earnings per share is $2.364. With sales of over 30 million, the CHAINZ bicycle company outperformed all of the first in the world won by more than 2 million, and exceeds the industry average of $9,557,282, and our profit after tax over $2 million exceeds of our direct competitor Hot Wheels by $734,734. We also exceed our average profit of $1,691,596. The CHAINZ bicycle company's overall strategy and marketing strategy have allowed CHAINZ company to outperform all other firms and exceed all average financial results of World 1.
The following report provides the income statement, balance sheet, financial management report, and financial analysis for CHAINZ Bicycle Company of the years 2014 to 2017. For our most recent income statement, our sales revenue was $13,117,507, less our cost of goods sold, which were $5,798,222. which gave us a gross margin of $7,319,285. Our marketing and distribution expenses were $3,857,568. We had no production management expenses. Our administrative expenses were $150,000. Our financial expenses were $80,000, and the total amount of our other expenses was $4,087,568. Our total income was $146,029, giving us a net income of $2,364,422. Our total current assets for 2017 were $9,033,446. Our total non-current assets were $1,968,300, giving us total assets of $11,001,346. Our total current liabilities were $1,013,324. Our total non-current liabilities were $1 million, and our total liabilities came up to $2,013,324. Our total equity was $8,988,022, and our liabilities and stockholders' equity was $11,001,346. For our vertical analysis of the income statement, the cost of goods sold had decreased as a percentage sale from 52.3% in 2014 to 44.2% in 2017. This means that for every dollar of revenue we make, it costs 44 cents to produce. Compared to our direct competitor, CHAINZ spends less money per dollar of sales revenue to produce bikes than Hot Wheels, with a percentage of sales at 47.6%. The CHAINZ gross margin of 2017 is 55.8% of sales, which has increased by 12.6% from 2016. Compared to the industry, CHAINZ exceeds the average percentage of sales by 4.1%. Given the high percentage of sales, CHAINZ outperforms all the other firms in World 1, including our direct competitor, Hot Wheels, with a gross margin of 52.4%. CHAINZ net income has reached $2,364,422, which is 18% of total sales in 2017. Between 2014 and 2015, CHAINZ has seen a drop in percentage of sales from 16.4% to 13%, but has recovered over the 4-year period to exceed our initial percentage of sales upon taking over the bike company. This shows that CHAINZ is outperforming itself in previous years, along with the rest of their rivals in World 1, including Hot Wheels. Our horizontal analysis of income statement. The sales revenue for CHAINZ has consistently increased throughout the 4-year period, but has slowed down recently. Our sales revenue for 2017 has increased by only 3.6% from 2016, which has previously increased by 21.8% from 2015. The industry average sales increase of 5% indicates that CHAINZ has not successfully met the sales revenue benchmark for World 1. Hot Wheels has increased their sales revenue by 5.2%, outperforming CHAINZ in the most recent years of sales. This suggests that sales revenue is a weakness for CHAINZ and should be prioritized. The cost of goods sold for CHAINZ in 2017 is $5,798,222, a 6% decrease in costs. This suggests that while CHAINZ might be losing sales revenue, they are counterbalancing this by producing more efficiently. Compared to the industry average of 0.5% increase on costs, CHAINZ is producing more efficiently than all the other firms in World 1, with the exception of Chain Reaction, with an 11.9% decrease in recent costs. Hot Wheels, our direct competitor, has increased their cost of goods sold by 5.2% to reach a total of $3,859,145. As a result, the efficiency in producing is the strength that CHAINZ has over its rivals. The profits for CHAINZ in 2017 are $2,364,422, which is a 23.2% increase from 2016. The gross margin in 2017 is $7,319,285, which is a 12.6% increase from 2016. In both cases, CHAINZ has proven to be more profitable than the industry average and increased their gross margin more than Hot Wheels, which has only increased by 10.2% from 2016. Given the increase in profitability, CHAINZ proves to be a top rival in the industry because of the attention to efficient production and of the mountain bikes.
So looking at the 4-year ratio analysis of our firm, solvency isn't a problem at all for CHAINZ. Looking at over the first 4 years, starting at a ratio of 3.9 to 1, which is already quite desirable, and then moving to, in 2017, a ratio of 8.9 to 1 for our current ratio, which is quite good. Our debt to equity ratio has been decreasing over the years as well, with our most recent year in 2017 being at 0.22 to 1. Looking at our profitability ratios, the return on sales started off a little bit on the downward slope, but then moving from 2016 to 2017, we had an increase of over 3%. And our earnings per share have also been increasing over the first 4 years, going to $2.4 a share. However, our return on equity has been an issue for us, moving down from 40% in 2014 to 26.3% in 2017. So looking at the financial statement analysis of our direct competitor, Hot Wheels, in 2014, they were pretty standard with the rest of us because we all started with the same prices. Moving to 2015, they had a bit of a rough year. Everything that they had decreased. Their wholesales decreased by 9%, cost of goods sold by 14%, gross margin decreased by 3%, and their profit after tax decreased by 5%. Moving to 2016, they had a bit of a better year. Their wholesale sales increased by 1.2%, however, their profit after tax still decreased by about 24%. And in 2017, they started to pick things back up, moving their profit after tax up by about 30%. So looking at the 4-year financial statement analysis of the entire industry, comparing CHAINZ to the industry average, In 2014, everything was pretty standard across the board again. Moving to 2015, we increased our profit after tax as a percentage of our wholesales. They were at 13%, which was just below the industry average of 14%. In 2015, our profit after tax moved to 15% of our wholesales, which were just above the industry average of 14%. And in 2017, we moved our profit after tax as a percentage of our wholesales to 18%, which is again just above the industry average of 17%. Now looking at the integrated cost, sales, and profit analysis of two chains, the direct competitor Hot Wheels and the industry average. Looking at our wholesales, they've increased, ours have increased by about 3.6%, Hot Wheels has increased by 7%, while overall the average has increased by 48%. Looking at our cost of goods sold, ours is about 3% less than that of Hot Wheels. Ours is about 44% of our wholesales, while Hot Wheels is 47%, and the industry average is 48%. Looking at our gross margin as a percentage of our sales, we have about 55%, while Hot Wheels has 52%, and the industry average is 51%. Looking at our profit after tax, we've got a percentage of 18%, while Hot Wheels remains at 15%, and the industry average is at 17%.
We believe our unit sales were successful because of our retail pricing strategy. We had the highest unit sales in our world, and this is due to the fact that we put a large amount of money in marketing in our firm's beginning critical years. We decided to sell this number of units because we knew this would get us the greatest profit.
From our initial price of $700 in 2014, we decided to decrease our price to $685 in 2015. This is so that we can attract more customers and by also increasing our brand. We then believe that by increasing our price in 2016, that would help to increase our overall profit because we already had the major customer base. We were actually wrong, and in conclusion, this actually helped to decrease our overall sales.
For market research, public relations does not play a large amount of success in the mountain bike industry. We found a way to keep our public relations awareness at a 0.1 throughout our turnovers, which is a desirable percentage to be at. Other companies in our world increase their public relations awareness percentage by over 10%, but then would decrease, which does not make sense because it is a waste of money. Whereas we stayed consistent throughout every turnover, which led to our companies not wasting unnecessary expenditures on public relations. That was so bad.
Our company put the most amount of money into advertising right away. We put a solid 80%, while all the other companies averaged around 40%. This is because we wanted to allow our product to be put in the market right away and allow branding to begin. As you can see from the graph, we put the most amount of money into marketing. Right off the bat, we put a total of 80%, while all the other companies averaged around 40%. We wanted to allow our product to be put right into the market right away and allow branding to begin. In the long run, companies that did not put a lot of money into marketing were not successful, and companies that did put a lot of money into marketing, including ourselves, ended up being very successful.
For distribution margin and support, due to the fact that many individuals were interested in our product as well as our strong promotion tactics, more customers wanted to buy our product, therefore we had more retailers wanting to sell our product.
Our firm sold a number of units it did because of advertising. We made sure to put a grand total of $500,000 into our business right away on our first turnover to create a strong brand and an overall customer loyalty. Also, we increased our advertisement steadily every year to help keep our customers. Therefore, customers when looking for a bike would rather a product that is well known, such as our product, instead of a product that is not advertised very well. We made sure to keep our PR awareness at 10% throughout the whole competition so that it was not always increasing or decreasing.
Quality stayed the same from 2014 to 2015 at 0.75, with $150,000 put into quality improvement. We moved quality improvement to $210,000, and it caused quality to go up to 0.76, which is a 1% difference. Our wastage went up 5% between 2014 and 2015, from 15% to 20%, 4% from 2015 to 2016, and went down 3% 2016 to 2017. Our reason for this wastage to go down would be because we improved our efficiency by 131,356 and quality by 1% in 2017. Based on the wastage and quality analysis, when the quality stayed the same from 2014 2016 to 2016, wastage went up about 5% a year. In 2017, when quality went from 0.75 to 0.76, which is a 1% difference, wastage went down from 24% to 21%. Our company had the cost of goods sold it did, which is $5,798,222, because we increased our efficiency expenditure from $250,000 to $181,356.
So for the capacity analysis for 2 Chains, it was evident that in our reports, all 7 firms in our world kept a constant capacity of 20,000 units throughout the 4 years. This is most noticeable in the fact that if firms were to adjust their capacities to a more realistic figure, such as lower it to 19,000, say if they were predicting 19,000 sales, then they would reduce their costs and would have less stagnant inventory, therefore having a greater profit. For our idle time analysis, between the years of 2014 and 2015, there was a staggering negative 47.5% in idle time, which was a promising figure for the firm's performance. For the inventory analysis of 2 Chains, we as a group decided that it would be smart to stick with only one product, that being our mountain bike. In the first year of 2014 and 2015, there was a 31% increase in the product inventory from the previous year. The next period saw a decrease in inventory level of a mere 22%, which was significant because of the corresponding idle time figures of that same year being negative 76.2%, meaning that there's less inventory sticking around. The final period of 2016 to 2017, there was a decrease in overall inventory levels of a staggering 21%. This is significant because of the corresponding wastage values in that same time period of negative 12.5%, the most favorable of all years, reflecting an increase in efficiency within the firm's operations.
Because we increased our efficiency expenditure from $250,000 to $381,356, making our company more efficient, and our cost of goods sold in 2017 go down to $5,798,222 from $6,100,065,928. This means that we could create the most amount of products, have the least amount of costs.
Go.
So to conclude our presentation, sales have been increasing at a much lower rate for 2 Chains. From 2016 to 2017, we only increased our sales by 3.6%, as opposed to 21.8% from our 2015 to 2016 years. In addition, this is much lower than the increase that Hot Wheels had of 7.8%. This is likely due to the change in price that 2 Chains had in their cost from $685 to $70. Let's try that again. To conclude our presentation, our sales have been increasing at a much lower rate. The 2 Chains sales have only increased by 3.6% from 2016 as opposed to the 21.8% increase from 2015 to 2016. In addition to their direct competitor, Hot Wheels, they've increased by 7.8%. This is likely a result of 2 Chains' decision to increase their retail price to $785. Our costs are also being managed quite efficiently. 2 Chains' cost of goods sold has been decreased by 6% to 44.2% of sales, which is 3.4% better than that of its direct competitor, Hot Wheels. Also, our profits are up. 2 Chains' profits after tax have increased by 23.2% from 2016, which is 18% of their sales. This is higher than that of their direct competitor, Hot Wheels, and the industry average. Overall, 2 Chains has been leading its world with profits, leaving them in a very good position for 2018.